Good afternoon from New York. It's 2:27 p.m. on Friday, March 27th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. Markets are open and we are watching a significant sell-off accelerate into the weekend. Let's get straight to the tape.
This is a full-spectrum risk-off session. The S&P 500 is at $6,383, down 1.46%. The Nasdaq is down nearly 2% at $20,989. The Dow is at $45,235, down 1.58%, and has officially entered correction territory, now more than 10% off its 52-week high. The Russell 2000 is down 1.75%. The VIX has broken above 30, sitting at 30.96, which is a clear signal the options market is pricing elevated tail risk heading into the weekend. The 10-year Treasury yield has climbed to 4.43%, its highest level since July, while the 2-year is at 3.61%. That 82 basis point spread tells us the curve is normal in shape, but the level of both yields is rising for all the wrong reasons. This is a geopolitically driven, oil-amplified, multi-factor sell-off. The primary driver is the Iran war and the Strait of Hormuz closure, pushing Brent above $112 a barrel. The secondary driver is Anthropic's new Mythos model report, hammering software and cybersecurity stocks. Both are feeding into the same risk-off impulse.
Walk us through the primary catalyst. Trump extended the deadline on Iran strikes to April 6th, so why isn't the market rallying on that?
Because the market has learned to discount deadline extensions. According to CNBC, Iran's foreign minister told state media this week that Tehran has no intention of holding talks with the U.S. The Wall Street Journal reported the Pentagon is considering sending another 10,000 troops to the Middle East. And critically, the Strait of Hormuz is effectively closed. Iran's Revolutionary Guard Corps said movement through the waterway will face a harsh response. 2 Chinese ships were turned away Friday, and a Thai-flagged cargo vessel that was hit in the strait has run aground. 20% of global oil supply transits that choke point, and it is physically disrupted right now. So Trump saying talks are going well is colliding with the reality of ships being turned away. Citi strategists captured it precisely, writing that continued deadline extensions by the U.S. are overall net negative for a resolution, and the incentives for both Iran and Israel do not necessarily align with a quick end. Brent crude rose 3% to above $112. WTI jumped 4% to above $99. This is the 5th straight weekly decline for the S&P, the first time that has happened since May 2022.
That Brent number is striking, over $112. Let me ask about the cross-asset picture, because this is clearly not just an equity story.
It is absolutely not. Here's the chain. Oil spiking above $112 on Brent is pulling inflation expectations higher. The University of Michigan's March Consumer Survey showed one-year inflation expectations rose to 3.8%, up 0.4 from February. That pushed Treasury sellers into the bond market. The 10-year yield hit as high as 4.46% intraday, according to Yahoo Finance, its highest since July. The 2-year yield climbed to 4%. Bank of America economist Aditya Bhave noted something important. Over the past 10 days since the Fed meeting, short-term rates have diverged from oil prices, meaning markets are now anticipating a more hawkish Fed reaction function, possibly a broader commodity shock. That yield surge is crushing rate-sensitive equities. Consumer cyclicals are among the hardest hit today. Starbucks is down 5.3%, Airbnb down 4.9%, Norwegian Cruise Line down 4.9%. Meanwhile, gold, which you would expect to rally in a geopolitical crisis, sold off sharply Thursday, down 2.79% to $4,379. Bitcoin fell 4.4% to $65,782. So safe havens are not behaving as safe havens. That is a correlation break worth naming. When both bonds and gold sell off alongside equities during a geopolitical crisis, it signals forced liquidation and margin-driven selling, not orderly repositioning. The only assets working are energy commodities and defensive sectors. Crude oil futures were the top gainer on the day, with WTI up 6.4%. Natural gas rose 4.1%. Halliburton gained 3.4%. Newmont Mining was up 3.2%. Consumer defensive names like Campbell's rose 4.3%, and Brown & Forman nearly 4% on merger talks with Pernod Ricard are working as portfolio hiding spots.
So let me ask the question every investor is asking. What does this mean for the Fed?
This is the most important shift of the week. According to CNBC, Fed funds futures pushed the probability of a rate hike by year-end 2026 to 52% Friday morning, the first time it has crossed the 50% threshold per the CME FedWatch tool. That is a regime change in expectations. 2 months ago, the consensus was firmly in the rate cut camp. Now we are pricing potential tightening. But here's the critical distinction. The Fed typically looks through energy shocks unless they feed into core inflation or inflation expectations become unanchored. The University of Michigan data is actually mixed on this point. 1-year expectations rose to 3.8%, but 5-year expectations edged lower to 3.2%. And survey director Joanne Hu noted consumers may not expect recent negative developments to persist far into the future. So long-term expectations are not yet unanchored. Philadelphia Fed President Paulson, who is a voting FOMC member this year, said Friday that if inflation is above 2% and has been for some time, she would be inclined to weight the possibility of overheating more heavily. Richmond Fed President Barkin used the fog metaphor, saying the decision to hold rates steady felt prudent. The base case is still a prolonged hold. The Fed is not going to hike on an energy shock alone, but the probability distribution has shifted hawkish. If Brent stays above $100 for another quarter and core inflation starts ticking higher, what was a hold becomes an increasingly uncomfortable hold, and a hike by late 2026 becomes the base case rather than the tail case.
So who are the clear winners and losers from today?
Cyclical winners, energy producers, full stop. Every single energy stock in the S&P is trading above its 50-day and 200-day moving average. Halliburton gained 3.4%. Occidental Petroleum is up 58% year to date. These companies benefit directly from Brent above $110 with minimal lag. Structural winners, utilities with data center exposure. Entergy gained 3.8% on news of a revised Meta data center deal in Louisiana. Nuclear power plays and regulated utilities are benefiting from the dual tailwind of defensive positioning and structural AI electricity demand. Also, consumer defensive names like Campbell's up 4.3% and Brown & Forman nearly 4% on merger talks with Pernod Ricard are working as portfolio hiding spots.
Cyclical losers, consumer discretionary names with fuel cost exposure. Carnival reported a solid earnings beat this morning, but is down because it carries no fuel hedging, and full-year guidance now reflects over $500 million in adverse fuel impacts versus prior assumptions. Norwegian Cruise Line dropped nearly 5%. Starbucks fell 5.3% as the Iran war pushes diesel costs higher through supply chains. Structural losers, software and cybersecurity stocks. CrowdStrike and Palo Alto Networks dropped 7%. Zscaler and SentinelOne tumbled over 8%. Tenable plummeted nearly 11%. This was triggered by the Anthropic Mythos model report from Fortune, which reignited AI disruption fears in the security space. This is now a recurring pattern. Every Anthropic announcement generates a sell-first reaction in enterprise software. And technology broadly is under structural pressure. Only 21% of tech stocks are trading above their 50-day moving average. Microsoft is down 24% year-to-date. Meta is down 19%. The Magnificent Seven are all in the red for the year.
Let me push back slightly. If earnings are still supportive, as Nationwide's Mark Hackett noted, and expectations have reset lower, isn't some of this selling overdone?
That is the right contrarian question, and it is exactly what some Wall Street strategists are starting to argue. Bloomberg reported today that some firms are encouraging investors to start buying again, and Citi's own note acknowledged that resolution proposals have been exchanged between the U.S. and Iran. The advance decline ratio today is 152 advancing versus 360 declining, which is bearish but not capitulatory. The AAII bearish sentiment is at 49.8%, the seventh consecutive week above historical average. Historically, that kind of persistent bearishness has been a contrarian buy signal. So yes, the alternative reading is real. If Brent were to retrace below 95 on a genuine ceasefire, yields could fall sharply and equities could recover multiple percentage points in a matter of days. The problem is timing. The weekend risk premium is real. Markets have consistently sold off on Fridays since the war began, as traders reduce exposure ahead of potential headline shocks while markets are closed.
What is the risk case investors should stress test?
Base case, which I would assign roughly 60% probability, the conflict drags on through April with intermittent deadline extensions. Brent oscillates between $100 and $115. The 10-year yield grinds toward 4.5%. The S&P 500 drifts to around 6,200, roughly another 3% lower, as the earnings backdrop remains supportive, but multiple compression continues. The Fed holds through at least September. Consumer spending slows modestly. Gasoline at $3.97 a gallon nationally per AAA is a real drag on discretionary budgets, but the economy avoids recession. Risk case, roughly 25% probability. The Strait of Hormuz closure extends beyond April. Brent spikes to $130 to $140. That forces the 10-year yield above 4.75% as inflation expectations become genuinely unanchored. Mortgage rates push towards 7.5%. The S&P 500 corrects to around 5,800, a full 13% below current levels and roughly 19% from the October high, approaching bear market territory. The Fed is forced into at least one 25 basis point hike by September. Consumer cyclicals, airlines, and unhedged transportation names could see 20 to 30% drawdowns from current levels. Software stocks, already in structural decline mode, face another 10 to 15% downside on top of what has already been a brutal year. For portfolio construction, highest conviction, energy producers maintain or gradually increase over the next 4 to 6 weeks. Occidental, Chevron, and oilfield services names like Halliburton have direct earnings leverage to sustained triple-digit crude. Secondary conviction, defensive utilities with data center exposure maintain structurally. Entergy, Constellation Energy, and NextEra benefit from both the risk-off rotation and the secular AI power demand theme. Tactical hedge, short-duration treasuries. With the 2-year at 3.61% and the Fed on hold, you are getting reasonable carry without taking duration risk in a rising yield environment. Avoid unhedged consumer cyclical names, particularly cruise lines without fuel hedging programs and high-multiple enterprise software companies that are vulnerable to every Anthropic headline.
How does it all fit together?
When you step back, this is really about one thing: the market repricing for a world where the Iran conflict does not resolve quickly, and the second-order effects of sustained triple-digit oil are just beginning to propagate through the real economy. Brent above 112 pushes gasoline toward $4, which compresses consumer spending power, which damages corporate revenue expectations in discretionary sectors, which pushes yields higher on inflation fears, which tightens financial conditions, which forces the Fed toward a hawkish bias it does not want to adopt. Meanwhile, the Anthropic Mythos headline is a reminder that even in a geopolitically driven sell-off, the AI disruption narrative is not going away. It is making software investors sell on any AI advancement, creating a secondary pressure channel on the Nasdaq that has nothing to do with Iran. The alternative reading is that this remains a supply shock-driven correction. The macro and earnings backdrop per nationwide is still supportive. Expectations have reset meaningfully lower, and a genuine ceasefire would trigger a sharp relief rally across equities, bonds, and consumer names simultaneously.
Give us 3 takeaways to close the week.
1. The risk. The VIX above 30 and the Dow entering correction territory heading into the weekend signal that portfolio insurance is getting expensive and forced selling has not yet exhausted itself. Do not underestimate the weekend headline risk. 2. The market insight. The Fed futures crossing 50% probability of a rate hike is the single most important repositioning of the week. Whether or not the Fed actually hikes, the shift from cut expectations to hike expectations changes discount rates, equity multiples, and credit conditions across the entire market. 3. Positioning. This is a barbell environment. Own energy and defensive utilities on one end, hold cash and short-duration bonds on the other, and reduce exposure to anything in the middle that depends on stable oil prices and benign financial conditions. The time to get aggressive on risk assets is when you see a genuine resolution in the Middle East. We are not there yet.
Thank you for listening. This is Lynx Data Insight, and we'll be back tomorrow with your next market briefing.